All right, let's talk about something that trips up so many people in crypto. Something that's honestly pretty dangerous if you get it wrong. We're going to tackle what I call the crypto tax myth.
You've probably heard it. There's this myth that floats around, this idea that gets whispered in Discord channels and on Twitter, especially to newcomers. And look, it's a really tempting idea to believe.
The myth goes something like this. Because crypto is decentralized, because you don't need a passport to open a wallet, the government just can't see what you're doing. It's pitched as this kind of digital Wild West, a tax-free zone where you can stack up gains and the taxman is none the wiser. Let me be completely clear about this. That idea, it's not just wrong, it's dangerously wrong. Seriously, believing this could land you in a world of financial and legal hurt down the road. So let's just rip the Band-Aid off and get into the reality of it all. The IRS is absolutely watching. And the funny thing is, the very technology that makes crypto feel so anonymous is actually what makes it incredibly transparent. You see, far from being some secret hiding place, the blockchain is probably the worst place on earth to try and hide money. Why? Because every single transaction is carved into a permanent, public, and unchangeable digital ledger. Think of it like a global spreadsheet that anyone can look at, and tax agencies have gotten really good at reading it. And listen, this isn't some new threat. Just look at the timeline of how this has ramped up. Way back in 2017, the IRS started sending out, "Hey, we see you" letters. Then by 2021, they slapped a crypto question right on the front page of the 1040 tax form for everyone to see. And now they're gearing up for automated audits. The trend couldn't be clearer. They are getting more serious and way more sophisticated every single year. Okay, so this brings us to the biggest pitfall, the #1 mistake that trips up, I'd say, 90% of beginners. I call it the taxable event trap, and it's the reason so many people get hit with a tax bill they never saw coming. So what exactly is a taxable event? Well, in the eyes of the government, it's basically any time you get rid of your crypto for something else. Selling it for cash? Yep, that's one. Spending it to buy a coffee? That's one too. But here's the big one, the one that gets everybody. Swapping one crypto for another. This right here is the whole ball game. Let's say you swap one of your ETH for 20 SOL. In your mind, it's just one move, right? You're just trading one digital asset for another. But that is not how the IRS sees it. To them, you just did two things. You sold your ETH for its cash value, in this case $3,000, and then you used that cash to go buy SOL. To see how this works, we got to start with your cost basis. Let's say you bought that one Ethereum a while back for $1,000, okay? That's our starting number. Now, let's look at the proceeds. At the exact moment you made that swap for Solana, your Ethereum was worth $3,000. The IRS treats that as your sale price. So you do the math, $3,000 in proceeds minus your original $1,000 cost, that leaves you with a $2,000 gain. And here's the kicker. That is a taxable gain that you owe taxes on right now for this tax year. And that, my friends, is the trap. You now officially have a tax bill. But wait, you don't have any more cash in your bank account than you did before, right? You're still fully in the crypto market. But a chunk of that portfolio's value is now owed to the government. This is how people end up with these massive, terrifying tax debts they can't possibly pay. Okay, I know that all sounds pretty intense. But the point of this isn't to scare you, is to get you prepared. So let's stop talking about the problem and start talking about the solution. It's time to go from feeling anxious to taking action. The first reaction most people have right about now is, whoa, wait a minute, I've made hundreds, maybe thousands of trades. How on earth am I supposed to track all of that? It feels completely overwhelming. I get it. And the answer is actually really simple. You don't. Software does. Trying to keep track of this on a spreadsheet is just asking for a migraine and, frankly, a disaster. The tools we have today are built for exactly this kind of mess. So here it is, your playbook. Step 1, use software. Connect your exchanges, connect your wallets, and let a crypto tax tool do the heavy lifting. Step 2, and this is a lifesaver, set aside about 30% for taxes. Every time you close a profitable trade, just move a piece of it over to a stable coin or cash. That way, the money's already there when the bill comes due. Third, use the market's craziness to your advantage. It's called tax loss harvesting. Selling assets that are down can create losses that cancel out some of your gains, lowering your total tax bill. And finally, step 4, when in doubt, get a pro. A CPA who actually gets crypto is worth their weight in gold, especially if you deep into DeFi or NFTs. Look, the main takeaway is this. Yeah, taxes are the boring part of investing. Nobody loves it. But if you ignore the boring stuff, it can spiral into a genuine legal and financial nightmare. A little bit of planning now saves you a whole world of pain later.
So I'll leave you with this question to think about. When you look at your own portfolio, at your own trading habits, are you really building wealth? Or are you just accidentally building yourself a massive future tax bill? The choice is really up to you.